Hi everyone, welcome to our second webcast for 2025. We want to give you a quick update in the next 10-15 minutes on the recent policy measures by Germany and the European Union that are going to boost growth in the euro area. We think these measures have very widespread implications, both for growth and asset markets. And we are in an environment where most investors are not positioned for these policies. We're not expecting these policies. We wrote about Europe's turnaround in our last Silver Bullet newsletter in February with the idea of a wake-up moment in Europe, and we're now seeing the results even faster and probably larger results than we expected. There's this quote by Lenin, which says that there are decades where nothing happens, and then weeks where decades happen. And that's essentially the environment where we are in. We have a 1.3 plus trillion stimulus, 1.3 trillion euro stimulus across Europe. Germany alone is doing a infrastructure and defense stimulus, which will be over 500 billion euros. So that's over 10% of GDP, which is 4.3 trillion for Germany. So Germany alone is doing over 10% across defense and infrastructure. We'll talk about the breakdown. On top of that, there is an EU defense instrument, which is going to be around 150 billion to aid spending. Probably will be followed by a loan facility for member states to add additional spending at the individual state level. And we expect member states individually to add around 650 billion of spending one by one. So in total, we're looking at a very large scale fiscal stimulus. So we can say that Europe has shifted to fiscal dominance. What are the implications? What are the other second order consequences? And where will the capital be spent? And also, what are the consequences for asset markets? First, looking at the German stimulus, this 500 billion of spending that's off budget will also come with a change to the deficit law. I mean, we all remember when Wolfgang Schäuble was finance minister that the zero target was celebrated. We're probably going to see a reform of that later this month, both with votes in the Bundestag and the Bundesrat. Everything that surpasses 1% of defense budget, 1% of GDP, will be exempted by the usual debt break limit, and there will be structural reforms to the debt break limit. So that is a big structural change, which will allow ongoing spending above the 1% limit. And on top of that, there is a 10-year fund in infrastructure, which will go around different areas from decarbonization to energy to transport across the infrastructure within Germany, but also will power other industries and suppliers across Europe. Where is the capital being spent? We don't know the details yet, but what we know is that various agencies have highlighted the shortfall in the current infrastructure across a number of areas, from local governments to railways to transport to energy, and particularly energy is one of the things that energy independence was highlighted by the Draghi report. And then there's defense, which is the larger part of the package. European countries have been lagging on defense spending. They've kept defense spending between 1 and 2% of GDP. We now think that the catch-up phase on this defense spending will push defense spending above 3% of GDP for a long time. And the controversial approach of the Trump administration towards Ukraine and towards Europe has bolted European governments to spend on defense in an independent way. We have seen for many years a lag across European countries on defense, with a few exceptions, for example, Poland or Greece. Most of European countries have been in a much lower scale spending, below the 3% target. So we see more room for catch up in Germany, but also Italy, also Spain, and across the euro area as a whole. Some European countries have already announced packages or commitments. For example, Scandinavian countries, obviously the Eastern European countries, but we believe that also countries in Central Europe will follow, and Southern Europe. The difference between the current stimulus that we are looking at and the previous stimulus is that in the past, defense spending had a very low multiplier on growth. It was around 0.5%. But typically, as the ECB president just discussed at the press conference, defense spending also increases productivity. It's positive. It increases innovation. But in the past, 60-70% of defense spending from European firms was going to US firms. From European governments was going to US firms providing products for European defense. In the future, and in particular in these new packages, especially the European one, we do think that the ratio of domestic spending versus capital that will go to US firms, would be much higher for European firms. So we're looking at something like 60-70% across Europe. So one of the outcomes, or one of the implications here is that the defense spending that goes to European firms is much higher. So the multiplier will also be higher. For infrastructure spending, we can think of a multiplier that's a lot higher already. It's closer to 1. But for defense spending, we think that the multiplier on growth will be higher than 0.5. So essentially, these packages altogether can lift European growth from something that was closer to zero, positive but close to zero this year, to something that's a lot closer to 1% and then 1.5% plus in the next few years. So far, it's been the reaction. We have discussed a lot about this with, first of all, with infrastructure and defense firms directly over the past months. As we were discussing this, we were thinking about this implementation. And then we've discussed with sell-side analysts and economists. And I have to say that typically when it comes to Europe, the approach and the mindset from economists and analysts is always to forecast, a low ball number for growth or for earnings, and then, think about whether there are risks to the upside. It's the opposite in the US, where typically the economist would forecast a high number and then think about the risks to the downside. So we still see that there's a catch-up in expectations. There's a catch-up around analysts that forecast earnings and economists that forecast growth in their estimates. And there's room for an upside surprise compared to the first reactions that have been elaborated around this. A lot of first reactions were, well, it's over a long period, it's too small, it's not enough, and we have seen Europe disappoint before. But which is true, and it's a valid point. There can be some pushback. The implementation and the execution are difficult, but we have seen a game-changing resolve from the German government, which is now a stable, proactive government, together with France, together with the UK, and Italy to some extent. The timeline to observe over the coming weeks will always, encompass obviously tariff decisions from the Trump administrations, but will also, the dates to look at are the 17th of March for Germany voting the package, and then the 2nd of March for the final vote in the upper house. In the meantime, there will be tariffs, there will be decisions around Ukraine and decisions around the package, the defense package for Ukraine. I want to say that this comes at a time where positioning across European assets, and we have flagged this before, remains extremely short. So we're still at the record short positioning for European credit across the last 10 years, across credit default swap indices. And the European underweight in European assets, European equities, has only recently started to fade, started to be reversed by investors. Investors are starting to cover their short in European equities, but it's a very long underweight. So what we have seen in the past few days is a lot of investors that had long US risk assets and short European risk assets have struggled to cover. They've been squeezed and short covered. And in duration, the same thing. Investors were long duration in the Eurozone and short duration in the US. But what we are now seeing is a reversal of that. The European inflation expectations was bumped a little bit higher by the ECB, not this year, but for the coming years. But the president did talk about a more two-sided risk. So probably the ECB will not cut to 1%, as a lot of people were thinking. They'll cut to 2%. They'll do another couple of cuts throughout the rest of the year. So what are our conclusions? Well, as we flagged before, we think that European leaders are at a game-changing moment here. It's a wake-up moment for Europe. It's a fiscal version of whatever it takes. So Germany's stimulus is extraordinary. It's over 10% of GDP, and other countries will follow in a smaller scale, but altogether, we are looking at something which will approach close to high single digits of GDP at the European level. It's not just spending, there's also reforms to strengthen the defense, energy, and infrastructure framework, and also to go into deeper integration. For example, clearly defense and infrastructure spending is something that Europe needs right now. So that's where a lot of the capital will go initially. What is the ramp-up period for defense firms? According to the conversations that we have had with many of the companies in the charts that we showed you, it is not 5 years. Ramping up production 20, 30% higher takes 6 to 12 months. So Europe will be ready to do more. And defense spending will have a higher multiplier compared to what we've seen in the past. So more spending, more capital will go on the margin to European firms rather than US firms. But it doesn't stop there, because European leaders have been through a lot of crises, and they've clearly understood the importance of consolidated strategic sectors. So energy, banks, telecoms, and space. Now, Eutelsat is a beneficiary, for example, compared to Starlink. Banks M&A is going to continue both across countries, intra-country, and inter-country. Very few would have imagined ING bidding for Sabadell, for example, a few years ago, but it has happened. There's been a headline on that. And obviously, national champions in Italy and Spain, continue to consolidate. The telecom industry as well is an important part of this puzzle. So consolidation of strategic sectors across Europe and the search for national champions. These are the first two steps. Defense and infrastructure right now, consolidation of strategic sectors over time. But I would say there's also long-term integration and the potential for today, flexing of fiscal rules, tomorrow potentially a financing instrument across Europe. This is obviously harder to implement, but we think it might happen. So these are the consequences, the implications that we see in Europe. Slightly higher growth this year, closer to 1% or around 1%, instead of closer to 0.5%. Germany going from negative growth to positive, spillovers across the most cyclical sectors. The implications are also outside of Europe, though. We have seen a change in stance across the UK and the UK media versus Europe. The UK has recently discussed the implementation of a free visa for young people between 18 and 30 years old from the EU. So there is a de facto softening of Brexit that is happening, and there's been some step in this direction. It is not open, it is not well advertised, but it could be something that creates upside. And we've seen a very much closer relationship between Starmer and President Macron in France. Finally, with regard to Ukraine, we still don't know the details of the negotiation, what will shape up, but we can imagine Europe playing a stronger, more firm role in a potential ceasefire with what might become a more stable outcome compared to an outcome where both Europe and Ukraine rely purely on US help. We don't know how much US participation there will be in terms of support, indirect support. We can imagine that having an extra support long-term by Europe will provide a more stable solution to Ukraine. Against this backdrop, we see very tight spreads globally across credit. And as we wrote in our last Silver Bullet investor letter, we are cautious. We are net short on the US market and generally net short on beta. This is the time to buy protection when spreads are extremely tight and volatility is extremely low. Having said that, there are assets in Europe, both in credit and looking at the whole capital structure of companies, not just the debt side, but also the equity side. There are assets in Europe that provide value in this very expensive credit and equity market. Sometimes a lot of assets in Europe can be a source of value, can be a source of upside. So overall, have been more cautious than we've ever been in the past few months since our inception. But there are opportunities for upside across European names, across cyclical sectors, across defense, across infrastructure. And generally, we're positioned to capture the volatility that comes from headlines, geopolitics, persistent inflation, and wider interest rates, as we have discussed over the past months. With that, I am opening up for questions. Please feel free to type up your questions, and we can start with a couple of questions that investors have been asking us maybe in the past few days, in the past few weeks.
Perfect. So if I can, thanks, Alberto. So I can start with the two questions over here, and I'm going to just summarize it relative to a question that we've already been asked. It seems like, in contrast to the U.S., which is advocating for, fiscal contraction, we're now seeing a fiscal expansion in Europe as a response. Do we think we might see something similar to China? And then, what would that mean?
So I think that essentially, if we take the game theory of this, it's a bit like the US has been pushing other countries in the world to do fiscal stimulus. Now, you could argue that maybe some of these countries, some of them were expecting this. Germany saved for 15 years for this moment. Might have been, something that politicians could have predicted or not. We don't know if it was expected. But one of the results of tariffs is that it's pushing other countries to take action, to take policy actions. Now, in obviously, some countries have more room than others. Germany had a lot of room. Italy will have less room. But overall, Europe has room. When it comes to China, there's a lot of counter currents. There's a lot of cross currents, and the economy and the demographics are not in great shape. Debt levels are high, but there's also additional policy levers that China can play. So do we think that there's going to be a massive stimulus? No, because the room for fiscal space is not there, and the decision makers have been a lot more cautious. But on the margin, we do think that there's going to be a bit more stimulus in China as well.
Another question which we're getting now focuses around some of the underperformance of recent U.S. assets relative to outperformance. How much of it sort of relates back to a chart which we had before, but how much of position squaring do you think we've seen on this relative underperformance? So it looks like from if we look at year-to-date moves, it looks as though Europe has repriced pretty significantly relative to the U.S. What do you sort of think about that when we think about positioning?
Yeah. So look, what we are thinking about, what we're saying on the growth, on the impact of the plan might not be surprising, but this comes at a time where investors were very often leaving European assets for dead. We're global, we don't need to be in Europe, but this has always been, in the past few months, has always been a very interesting situation where we had record short positioning across, for example, European autos, record short positioning across European CDS indices. And on the other hand, fundamentals were pretty solid. European companies were deleveraging, and we have seen this. We've seen this willingness from governments to do more, and willingness from the ECB to support the market. So right now, what do you have in Europe? You have a situation where Germany is deploying a double bazooka: infrastructure and fiscal, infrastructure and defense. And the ECB is still dovish, is still data dependent, is still backward looking. They're still easing another 2 times at least this year. So you have both fiscal and monetary easing. Until the ECB pauses, there's going to be at least 6 months. So that's pretty, it's a pretty strong cocktail for, for risk on, for curve steepening and repositioning of investors.
And I think
we have one more question.
Yeah, I think it ties in nicely into what you were just talking about, which is how long does the fiscal stimulus take to sort of feed into earnings? And I think, as you were saying, there's sort of 2 ways to think about that. One is generally people are pretty bearish, both from an analyst perspective as in terms of individual companies, but how quickly that might translate. Our conversation with companies across defense as well as other cyclical sectors is that the ramp up is a lot quicker than the market is currently expecting. So historically, the fiscal stimulus has taken time, but we think this time is actually quicker.
So I have 2 questions: one on earnings, one on inflation. On earnings, defense and infrastructure will have a quicker impact. So there will be government decisions that takes time. but it's been very quick so far. And so we think that's a 3 to 6 month period for that spending to be deployed. And obviously, there needs to be approvals also at the local level. But I would say it's something like 3 to 6 months for infrastructure and defense. And defense companies have been already on the ball on this. We've seen a lot of announcements by the Rheinmetall CEO, by the Leonardo CEO. There's already JVs between the two companies, and also between the UK and Germany, between Germany and Italy, between Italy and Turkey. So there's been a lot of discussions around creating a national champion, a European champion, and different national champions for different products. In light of the fact that U.S. supplies of weapons can be turned off. So when it comes to the broader growth impact, so consumption, will European consumers spend again? Will European auto demand, spend again? I mean, that's going to take longer. So we're looking at 26, 27, but the growth path has definitely become a little steeper compared to where we were before. So, this year, maybe we go, I don't know, from 0.8% to 1%, but like next year, the positive impact is higher. So we might go above 1.5. It takes out the negative tail scenario for Europe, which a lot of investors were very focused on. And that's why a lot of investors were very long on duration in Europe, for example, and not so much on credit. Second question on inflation. This happens in an environment where Europe does not have an inflation problem. So we don't think that European inflation would be substantially above target yet this year. Just a little bit above target, maybe 0.2% above target, 0.1% above target. It's not an inflation issue yet. It's not going to make the ECB think about hikes. We don't know what happens next year, but it's an interesting situation for the European economy because we still can have monetary expansion at a time where fiscal expansion was so much needed. In the US, the situation is different. We have monetary expansion towards the end of the cycle. The Fed is going to struggle with inflation about 2.5 this year. And even though the economy is hitting some bumps, and fiscal, well, there is a discussion around fiscal tightening in the US, which we can discuss for a long time, but we think that the bias is towards tightening. So the US has already used a lot of fiscal and monetary ammunition. Investors are overweight US assets, while in Europe we have a completely opposite setup where investors are underweight European risk assets. Monetary easing can still be used, and fiscal is just at the beginning. And there's one more question on a potential ceasefire dampening defense spending. I think defense spending here is structural. European leaders have understood that they need independent defense. So it will continue regardless of a ceasefire. Actually, maybe the ceasefire is a catalyst for Europe to defend itself from a potential rearmament in Russia. Caesar used to say, "Si vis pacem para bellum." I mean, it's clearly not a bad thing to have some extra defense in an environment where NATO might be less liable, let's say. So I think that's been the game changer realization of the last few weeks, few months. And I think that even with a ceasefire, with the political stance in Russia and the focus from the US on China, Europe will be left to defend itself and to ramp up that spending. And we're just at the beginning of a very long catch up. Happy to discuss the implications for traditional defense companies, but also for other defense companies that we've been looking at one by one if you want to follow up. I think we have no more questions. Obviously, the topic is very large, but we've been discussing it for some time in the past few months. We've been thinking about a turnaround in Europe, and even though we can buy assets in other places in the world, the European positioning was pretty interesting to us. So I would say, please feel free to be in touch with us if you want to follow up on any of these points and the opportunity set. And we're very happy to discuss. And good luck with the coming weeks. Thank you.
Thank you.